Every single day, someone is trying to sell you a dream. Your broker calls with a sure thing. A FinFluencer on TikTok tells you they've found the next 100x gem. Your bank is pushing a premium mutual fund with a 2% fee. Benjamin Graham knew that the biggest threat to your wealth isn't the market. It's the person sitting across the desk from you. Welcome to Chapter 9 of The Intelligent Investor. The Investor and His Advisors. This is the chapter where Graham teaches you how to spot a predator, how to hire a partner, and why most experts are actually paid to keep you average. Today, we're going to find out if you should be the captain of your own ship or if you're about to pay a pirate to sink it. Let's get one thing straight. In the financial world, free is the most expensive word in the dictionary. Graham warns us that most people get their advice from brokers. But here is the fundamental conflict. The broker's goal is to generate commissions, or order flow. They get paid when you move money. The investor's goal is to build wealth. You get rich when you hold money. Graham says that asking a broker for investment advice is like asking a car salesman if you need a new car. The answer is always yes. In 1949, they charged commissions. Today, they use payment for order flow and gamified apps to trigger your FOMO. They aren't your advisor. They are a salesperson. The intelligent investor knows that a hot tip from a broker is usually just a way to generate a fee for the firm. Now let's talk about the big guns, the investment banks and their army of analysts. These are the people who put out those fancy buy, sell, and hold ratings on stocks. You might think, these are the pros. They must know what they're doing. Graham would tell you to be extremely skeptical. Why? Because their business model is not about giving you unbiased advice. Investment banks have many departments. The research department analyzes stocks, but the investment banking department helps companies go public or raise money. Who pays the bills? It's the companies, not you. So, if an analyst's bank is trying to win a multi-million-dollar deal with a company, do you really think that analyst is going to slap a sell rating on their stock? It's a massive conflict of interest. Graham observed this decades ago, and it's even more true today. The research you see is often just marketing material in disguise. The goal is to maintain good relationships with corporations, not to make you rich. So, when you see a strong buy recommendation, the intelligent investor's first question should always be, who benefits from this buy? This brings us to the modern version of the stockbroker, the so-called FinFluencer on platforms like TikTok and Instagram. They flash fancy cars and tell you about a secret crypto that's about to explode. They promise you financial freedom if you just follow their trades. Graham would have seen right through this. These influencers are often engaged in what's known as a pump and dump scheme. They buy a low-priced, obscure stock or coin, then they create hype around it, telling their thousands of followers to buy in. As the price skyrockets from all the new buyers, the influencer sells their own shares at the top, making a huge profit. And who's left holding the bag when the price crashes back to earth? You are. They aren't advisors. They're performers. They're selling you a ticket to a show where you're the one who pays the price. The intelligent investor doesn't chase hype. They analyze value. So if brokers, analysts, and influencers are all compromised, who can you trust? Graham suggests a different kind of advisor, a fee-only fiduciary. Let's break that down. Fee-only means they are paid a flat fee for their service, not commissions for selling you products. This removes the incentive to churn your account. Fiduciary is a legal term that means they are required by law to act in your best interest. This is the absolute gold standard. A true fiduciary success is tied directly to your success. But Graham adds a crucial point. Even with the best advisor, you can't outsource your own intelligence. You are the CEO of your own financial life. An advisor is a consultant, not your boss. You must have a basic understanding of your own investment policy, your goals, and your risk tolerance. You need to be able to ask your advisor tough questions. For example, why are you recommending this fund? What are the fees? How does this fit into my long-term plan? If they can't give you clear, simple answers, or if they try to dazzle you with jargon, that's a huge red flag. An honest advisor educates you. A dishonest one confuses you. The ultimate responsibility for your financial future always rests on your shoulders. Now, what about those expensive, actively managed mutual funds that your bank is always trying to sell you? The ones with the glossy brochures and the impressive sounding names. Graham was one of the first to point out a simple, devastating truth. The vast majority of these funds fail to beat the market average over the long run, especially after you account for their high fees. Think about it. A fund might charge a 2% management fee. That might not sound like much, but over 30 years that fee can eat up more than half of your potential returns. The fund managers get paid their handsome salary whether the fund goes up or down. You're the one taking all the risk, while they're guaranteed a paycheck. Graham's solution was simple and elegant. Instead of trying to find the one genius manager who can beat the market, why not just buy the market itself? This is the core idea behind index funds, which simply own a piece of every company in a major index like the S&P 500. They have incredibly low fees because there's no high-paid manager making guesses. You are guaranteed to get the market's return. For Graham, this wasn't about being average. It was about being smart. It's about recognizing that the high-fee game is rigged against you and choosing not to play. The intelligent investor doesn't pay for someone else's gambling addiction. So let's bring it all together. What is the key takeaway from Chapter 9? It's that your greatest defense in the investment world is not a fancy algorithm or a hot tip, but a healthy dose of skepticism. You must operate on the principle of trust, but verify. Graham teaches us to always question the motives of the person giving us advice. Are they a salesperson, a partner, or a performer? Are they being paid to make you money or to make money from you? The final and perhaps most important piece of advice from Graham is about knowing yourself. He divides investors into two types: the defensive investor and the enterprising investor. The defensive investor wants safety and freedom from bother. For them, a simple portfolio of low-cost index funds and bonds is the perfect solution. The enterprising or active investor is willing to put in the time and effort to research individual stocks in the hopes of beating the market. But this path requires serious work, discipline, and emotional control. The biggest mistake you can make is thinking you an enterprising investor when you really a defensive one. If you don't have the time or inclination to do deep research, but you still trade based on tips and feelings, you're not investing, you're speculating. And speculators almost always lose. Be honest with yourself about how much work you're truly willing to do. Choosing the right path for your personality is the most important investment decision you'll ever make. In the end, The Investor and His Advisors is a chapter about empowerment. It's Graham's way of telling you that you don't need to be a Wall Street genius to succeed. You just need to understand the rules of the game and know who's playing on your team. You need to build a fortress of knowledge around your money with a deep moat of skepticism to keep the predators at bay. The market will always be volatile, but your principles don't have to be. So what about the so-called experts? You know, the people you see on TV, the ones in those sharp, expensive suits on business channels, confidently telling you where the market is headed. Benjamin Graham points out something that's honestly a little terrifying. An advisor can be 100% honest, genuinely believing what they're saying, and still be 100% wrong. Think about that. They're not trying to deceive you. They just don't know. Graham actually analyzed the big investment counsel firms of his era. These were the top dogs, the most respected names in the business. And what did he find? They rarely, if ever, actually beat the market average. It's a shocking realization. So why does this happen? The core issue is something called groupthink. It's a psychological trap. In the world of high finance, advisors are incredibly afraid of being wrong and alone. If they make a bold, contrarian bet and it fails, their career could be over. So, what do they do instead? They huddle together. They all make similar predictions, buy similar stocks, and follow the same trends. This way, if they're wrong, which they often are, at least they're wrong and together. There's safety in numbers. They can all point to each other and say, well, everyone thought that was a good idea. This herd mentality protects their jobs, but it does absolutely nothing for your portfolio. This brings us to a fundamental rule from Chapter 3 of Graham's book, The Intelligent Investor. If an advisor sits across from you and claims they can predict with certainty where the S&P 500 will be in 6 months, or which tech stock is going to be the next big thing, they are violating the very essence of intelligent investing. At that moment, they've stopped being an advisor and have become a fortune teller. They're trying to sell you a crystal ball. And as we've learned from Graham, the first thing an intelligent investor does is smash that crystal ball to pieces. The future is unknowable, and anyone who claims otherwise is either a fool or a liar. So, does this mean Graham thinks you should just go it alone, navigating the treacherous waters of the stock market all by yourself? Well, not necessarily. He was a pragmatist. He understood that different people have different temperaments, different amounts of time, and different levels of interest in managing their own money. He basically divides the investing world into two distinct groups. First, you have the do-it-yourself investor. If you've embraced the defensive investor mindset we've talked about before, the one that focuses on simplicity, safety, and avoiding costly errors, you probably fall into this category. You're the kind of person who uses simple strategies like a 50-50 split between stocks and bonds, or invests primarily in low-cost index funds that just mirror the market. If this is you, congratulations. You likely don't need to pay anyone a dime for investment advice. You have the discipline and the strategy to be your own best advocate. You're in control and you're keeping your costs rock bottom, which is a huge advantage over time. But then there's the second group, the help seeker. Graham acknowledged that not everyone has the emotional fortitude to handle the wild swings of the market. And this is the only time he says you should really consider hiring an advisor. But here's the critical distinction. You're not hiring them to be a stock-picking genius. A truly great advisor in the Graham tradition isn't a stock picker. They're not trying to find hidden gems or time the market. A great advisor is a financial bodyguard. Their most important job is to protect you from your own worst impulses. They are the person who stands firmly between you and that glowing red sell button when the market suddenly crashes. 30% and every instinct in your body is screaming, "Get out now." You see, you aren't paying them for their alpha, that's the industry term for outperforming the market. You're paying them for their omega. You're paying them for their ability to stop you from doing something catastrophically stupid, like selling all your investments at the very bottom of a downturn and locking in massive losses. Their real value is behavioral coaching. They keep you on the right path, reminding you of your long-term goals and preventing panic from derailing your financial future. They provide the emotional discipline that you might lack. That's a service worth paying for, but paying someone to guess the future? According to Graham, that's just a waste of money. So if you're thinking about hiring a financial advisor, how do you find a good one in today's world? We can actually turn to Graham's wisdom, but let's update it for 2025. I call this the Graham test. And it has 3 non-negotiable rules. If a potential advisor fails even one of these, you walk away. First, rule number 1, the fiduciary standard. This is a big one. You need to ask them directly, do you have a legal obligation to put my interests first? This is what being a fiduciary means. If they hesitate or if they tell you they're a registered representative, that's a red flag. A registered rep only has to provide suitable advice, not the best advice for you. Think about that. Suitable just means it fits a general category. Best means it's the top choice for your specific situation. You deserve the best, not just something that's good enough. Insist on a fiduciary always. Second, rule number 2, fee only versus commission. How do they get paid? This is crucial. You should never ever pay an advisor a commission for a trade. When they make money every time you buy or sell something, what do you think they're going to encourage you to do? Trade more, of course. Their incentive is activity, not your long-term success. Instead, look for a fee-only advisor. They'll charge you for their time, like an hourly rate, or a flat, transparent percentage of the assets they manage for you. This aligns your goals perfectly. When your portfolio grows, their fee grows. When you win, they win. It's a partnership, not a transaction. And finally, rule number 3, the sleep test alignment. This ties back to everything we've talked about regarding being an intelligent investor. Does this advisor respect the foundational principles of sound long-term investing? Do they talk about value, margin of safety, and managing risk? Or are they pitching you the latest hot trend? If they suggest you put your retirement savings into 0-day to expiration options, or some speculative moonshot crypto coin, they are not an advisor. They are a gambler playing with your money. You need to fire them on the spot. A true advisor helps you build wealth patiently and protect it fiercely. They help you sleep well at night, not keep you up wondering if your life savings will be gone by morning. These 3 rules, fiduciary standard, fee only, and the sleep test, are your shield. They protect you from the wolves of Wall Street and ensure that anyone you bring into your financial life is truly on your team. Don't compromise on them. Now it's time for an action plan. I call this the gatekeeper audit. This is your mission, and it's one of the most important exercises you can do for your financial health. Your job is to become the strict, no-nonsense gatekeeper of your own wealth. First, I want you to identify the source. Take a look at the last 3 investment decisions you made. Could be buying a stock, a fund, anything. Now be honest with yourself. Who or what prompted you to make that decision? Was it based on your own careful, math-based analysis of the business? Or was it a hot tip from a friend, a suggestion from a broker, or something you saw on a flashy social media post? If the person who gave you the idea made money from your transaction, you need to be very critical of that influence. The goal is to separate sound analysis from sales pitches disguised as advice. Second, the fee reveal. This is for those of you who already have a professional advisor. I want you to do some digging. Find out exactly how much you paid them in total dollars over the last 12 months. Don't just look at the percentage. Percentages can be deceiving. For example, a 1% fee on a $500,000 portfolio doesn't sound like much, right? But do the math. That's $5,000 a year. That's over $400 a month. Now ask yourself the hard question. Is the advice I am receiving worth $400 every single month? Maybe it is, and that's fantastic. But maybe you'll find you're paying a premium for basic cookie-cutter advice you could get elsewhere for far less. You can't know until you see the actual dollar amount. Knowledge is power. And third, the influence mute. This one might be the most fun. I want you to open up your social media apps, YouTube, TikTok, Instagram, X, all of them. Scroll through the accounts you follow for financial advice. I want you to unfollow every single guru who promises guaranteed returns, secret strategies, or shows off a lavish lifestyle funded by their foolproof system. These people are not investors. They are speculators. And often their real product is selling you a dream, not providing real education. They prey on your desire for a shortcut. But as we know, in investing, there are no shortcuts. Mute the noise. Curate your feed so it's filled with sources that promote discipline, patience, and realistic expectations. Completing this gatekeeper audit is a massive step. It's about taking control and consciously deciding who gets to have a voice in your financial life. Remember, being an intelligent investor means you are the CEO of your own wealth. You are the boss. You can hire staff, like a good fee-only fiduciary advisor, to help you manage things. But you never, ever give up the power of the final decision. The buck stops with you. You are in charge of your financial destiny, and that's an incredibly powerful position to be in. Thanks for watching. Take this audit seriously. It can truly change your financial future. If you found this helpful, be sure to like the video and subscribe for more content to help you on your journey. See you next time.